Hey everyone, and welcome to This Explainer. Today, we are breaking down the absolute foundation of building wealth. We're going to answer a question you've undoubtedly seen all over your social media feeds, heard on the daily news, and honestly, probably even debated around the dinner table. We are cutting through all the noise and that complex financial jargon to give you a crystal clear picture of how this whole thing actually works. Okay, let's dive right in and ask the big question. You know the phrase, right? When people talk about buying the dip, or when they brag about investing in companies like Tesla or Apple, what are they actually purchasing? I mean, are they just buying some magical number on a digital screen that randomly bounces up and down? No way. To truly master your finances, you have to understand the mechanics beneath the buzzwords. So let's start at the very beginning with Section 1. What exactly is a stock? To build our understanding from the ground up, we need to clearly define what a stock is, because the reality is way more tangible than just a ticker symbol on your phone. Simply put, a stock represents actual, literal ownership in a company or a business. When you buy a stock, you aren't just placing a bet in a casino. You are buying a legitimate, legal stake. You own a tiny piece of that actual business. Whether they're selling cars or software or even coffee, as a stockholder, you are literally an owner of that enterprise. Think of it like this. Imagine your absolute favorite streaming service is a delicious chocolate cake, and the whole thing is cut into slices. Each slice of that cake is what we call a share. Now, if the entire company was divided into exactly 10 shares total, and you bought 5 of them, well, you literally own half of that entire company. Now, sure, in the real world, massive global companies are chopped up into millions or even billions of shares, meaning your personal slice is a much smaller percentage. But the fundamental concept remains exactly the same. You have a seat at the ownership table. Let's move right along to Section 2, funding a dream business. So let's explore a super practical question here. Exactly why would a successful business want to sell pieces of itself to random people like you and me? Well, it all comes down to cash. Creating and growing a business is incredibly expensive. Companies need money to build new factories, develop revolutionary products, or honestly, just keep the lights on and pay the bills. Now, they could go to a bank and borrow the money, but then they'd have to pay it all back with some pretty hefty interest. Instead, companies issue stock to raise cash that they actually get to keep. To see how this works, let's look at an entrepreneur named Maya. Maya has this massive dream to open a limited edition sneaker store called Fresh Kicks. She's done all the math, and she calculates she needs exactly $100,000 to make her dream a reality. But here's the hurdle. Maya only has $50,000 saved up. So instead of burdening her brand new business with a massive, stressful bank loan, she divides her business into 10 equal shares of $10,000 each. Because she's putting in her own 50 grand, she keeps 5 of those shares for herself, giving her 50% ownership. Then she sells the remaining 5 shares to outside investors. Enter Jordan. He's a local sneakerhead who thinks Fresh Kicks is absolutely going to revolutionize the scene. So Jordan buys 1 share for $10,000, which secures him a 10% stake in the store. Thanks to investors like Jordan, Maya secures her 100 grand, and Fresh Kicks is officially open for business. Now, when things go right, they can go really right. Let's visualize this massive success over a 5-year timeline. Maya opens the doors in year 1 with that $100,000 valuation. Fast forward to year 3, and she is expanding the business, opening 3 brand new locations. By year 5, Fresh Kicks is absolutely crushing it. The company's overall valuation has tripled to $300,000. So the crucial question is, what does Maya's wild success mean for our investor, Jordan? Well, because Jordan owned 10% of the company right from the very beginning, his initial $10,000 investment grew right alongside the business. His 10% share of a $300,000 company is now worth $30,000. If he decides to sell his slice of the business today, he walks away with an incredible $20,000 profit. And guys, that is the thrill of the market. You get to profit from a company's hard work and growth just by being an owner. But we have to look at the flip side here, because investing isn't always a fairy tale success story. What if things go wrong? Let's say Fresh Kicks really struggle to compete with giant online retailers. Sales slump and the overall business valuation drops from $100,000 down to $80,000. Jordan's 10% share would drop right along with it, shrinking in value down to just $8,000. If he sold then, Jordan would actually lose $2,000 of his initial money. Ouch. But this is exactly how stocks work in the real world, just scaled up to a massive level. When the business wins, you win. When the business loses, you lose.
And that brings us perfectly to Section 3, the Stock Exchange Marketplace.
Knowing all of this, the next logical step is understanding where to actually go shopping for these company slices. Think of a stock exchange as a giant, bustling marketplace. Kind of like a farmer's market where you go to buy produce, the stock exchange is where people go to buy and sell shares of companies. The most famous ones you'll hear about are the New York Stock Exchange, or NYSE, and the NASDAQ. And honestly, the incredible thing about living in today's digital age is that you don't even have to physically be on some chaotic trading floor in Wall Street to participate. You can buy and sell these shares directly from investing apps right on your smartphone, literally while sitting on your couch. But how do companies get onto those apps in the first place? Well, it's all about scaling up. When a widely successful local store like Fresh Kicks eventually expands into a massive national chain with hundreds of stores, it needs way more money to operate. At that point, it might decide to go public by listing on these exact exchanges. Going public simply means they're unlocking the doors and allowing absolutely anyone in the general public to invest and buy a slice of their company. Next up, Section 4, Common versus Preferred Shares. All right, before you go tapping that buy button on your app, you really need to know that not all stock shares are created equal. The source material uses a fantastic analogy here, and I love this. I want you to think of common stock and preferred stock exactly like regular tickets and VIP tickets to the exact same concert. Both tickets get you in the door to see the show, right? You're an owner of the company either way. But once you're actually inside, they offer completely different perks, completely different experiences, and different levels of reliability. When we compare the two financially, here is how it actually breaks down. Common stock is what most people mean when they talk about buying stocks. It gives you voting rights on major company decisions, meaning one share equals one vote. It also gives you the absolute highest potential for growth if the company skyrockets. But, and this is a big but, it comes with higher risk. There are absolutely no guaranteed profit-sharing payouts, which are known as dividends. If the company has a rough year, you get nothing. Preferred stock, on the other hand, acts kind of like the responsible older sibling. You are trading away your voting rights and some of that explosive growth potential, but in exchange, you get fixed, reliable dividends. Preferred stockholders get their slice of the profits before common stockholders ever do. It's a really attractive option for people who just want steady, reliable income with a whole lot less drama. To truly grasp the extreme risk associated with common stock, just consider the bankruptcy payout order. If a company completely fails and goes under, it is not a free-for-all. There is a very strict line for who gets paid from whatever cash happens to be left. Step 1, the company legally has to settle its debts with lenders and banks. Step 2, preferred stockholders step up to receive the remaining funds. And Step 3, common stockholders are stuck at the very back of the line. Very often, by the time the accountants even get to Step 3, the money is entirely gone, and common stockholders receive absolutely zero. That is the harsh reality of the risk you take for that higher growth potential. Finally, let's bring it all home with Section 5, the risk and reward. So let's pull all of this together. With all this talk of risk and bankruptcy, you might be asking yourself, why does anyone do this? Why risk your hard-earned money on this wild roller coaster instead of just keeping it perfectly safe in a traditional bank account? Well, it all comes down to the math. While a standard bank might give you a very safe, guaranteed 1 to 2% annual interest, the stock market has historically returned an average of 7 to 10% per year over the long term. That incredible difference in potential growth is exactly why investors are willing to stomach the ups and downs of the market. It is quite literally the engine of long-term wealth building. Ultimately, as we wrap up today's explainer, I really want you to remember these key takeaways. Number 1, you are buying actual ownership in a real business, not just some flashy digital token. Because of that, number 2, you should start by investing in companies that you actually understand and believe in. Third, recognize your own strategy. Are you patiently investing for long-term growth over decades, or are you looking for quick trading profits based on rapid price changes? And finally, the golden rule of investing. Never, ever put all your eggs in one basket. Diversify your investments so if one sneaker store struggles, your entire financial future doesn't struggle right along with it. So, keeping Maya's sneaker store, those VIP concert tickets, and your own long-term financial goals in mind, I want to leave you with this final thought. Are you ready to stop just watching the market from the sidelines and actually start owning a slice of it? The stock market isn't just for Wall Street insiders anymore. It is a tool for absolutely anyone willing to learn. The only question left is, which slice of the cake are you going to choose? Thank you so much for joining me, and keep exploring the amazing mechanics of the world around you.